All right, let's jump right in. Today, we're going to tackle a question that, let's be honest, every single founder wrestles with at some point.
Yeah, this is the big one, isn't it? It sounds like such a simple question, but man, finding a real, solid answer, that's tough. And it matters so much, right? Whether you're looking to sell, trying to get investors on board, or you're just planning out your next few years, you need to know this number.
And look, if you've already tried to figure this out yourself, you probably know exactly what I'm talking about. It feels just like being lost in a maze. You take one turn, you get one answer. You take another, and suddenly the number is completely different. It's just super frustrating.
But hey, that's why we're here. Don't worry. Think of us as your guide today. We're going to hand you the map to get through this valuation maze so you can actually find a clear path and feel good about it.
Okay, so the very first step to getting through any maze is just understanding where you can go. And when it comes to business valuation, there are really three main paths. And I want you to stop thinking about them as these scary, complex formulas. Instead, just think of them as three different ways to look at your business's value. So let's pop open the toolkit, shall we? You've got three core methods to work with: asset-based, income-based, and market-based. These are the absolute essentials for the journey ahead. Let's break them down one by one. All right, first up, the asset-based approach. This one is probably the most straightforward of the bunch. You literally just add up everything you own, your computers, your office furniture, the cash in the bank, and then you subtract everything you owe, like loans. Simple, right? It's a snapshot of your net worth right now. But there's a catch. What if you're a service business? Maybe a consultant with amazing client relationships, but not a lot of stuff. Well, this method can totally miss the mark and seriously undervalue what you've built. Okay, next up is the income-based method. Now, this one's all about your earning power. It's looking to the future. It basically asks, okay, how much cash is this business actually going to make down the road? This is fantastic for businesses that are already profitable and stable. The only problem? It's built on a whole lot of assumptions. You're basically trying to predict the future. And, well, that's always a bit tricky. And that brings us to our third path, the market-based method. You can think of this one like buying a house. What do? You look at the comps. What have similar houses in the neighborhood sold for? It's the same idea here. You value your business by seeing what similar companies have recently sold for. It makes a lot of sense, right? It feels grounded in reality. But, and this is a big but, it all hinges on being able to find businesses that are truly comparable to yours. So when you lay them all out like this, you start to see a pattern. Each one has its moment to shine, but each one also has a pretty big pitfall. Asset-based, well, it ignores the future. Income-based, it kind of needs a crystal ball. And market-based, you risk comparing apples to oranges. And this all leads to a really crucial point. There is no single best method. It just doesn't exist. Which, of course, brings us to this huge common trap that so many people fall into. It's this myth that there's some kind of one-size-fits-all formula for valuation. And let me tell you, believing that is the fastest way to land on a number that, well, it might look right on paper, but in your gut, you know it's just wrong. You really have to ask yourself this question, especially when you're looking at those market comps. Wait a minute, is that really an apples-to-apples comparison? When you see that another company sold for X amount, you have to dig in and challenge that. Is their business really like yours? And here's why that question is so important. That generic company they're comparing you to, maybe they have a team of 10 people, but you're a solo founder with these incredible deep relationships with your clients. Maybe they're a generalist, while you completely dominate a very specific niche market. All those unique things about your business, the stuff that actually creates your real value, it all just gets lost when you're doing a simple apples to oranges comparison. So what do? If one method isn't the answer, what is? Well, the solution is a really smart strategy called triangulation. Think about it. Instead of just picking one path and hoping it's the right one, you use multiple paths to find your exact location on the map. It's all about getting a much more balanced, much more informed view of where you stand. And you can get started with this pretty easily. It's a simple three-step thought process. First, you've got to assess your data. Like, what numbers do you actually have that are reliable? Second, you have to know your own business model. Are you heavy on assets, or are you all about future profits? And third, be clear on your goal. Why are you even doing this? Are you selling? Looking for money? Just curious? Your answers to these questions are what will tell you exactly how to mix and match the methods to get the clearest picture. And please, hear me on this. Using two or even all three of these methods, that's not a sign that you're confused. It's a sign that you're being smart. It's a robust strategy. It lets you check your work, basically, and land on a valuation range that you can defend and feel truly confident about.
Now, I know what some of you are thinking. I can do this myself. And look, I get it. It's tempting to DIY the whole thing. And honestly, understanding these basics is absolutely crucial. But there are definitely times when you need to call in a pro, an expert guide to help you through the tricky parts. Because a good professional appraiser does so much more than just punch numbers into a spreadsheet. They know how to adjust your financials to reflect what's really going on. They pick the right discount rates for your specific industry. They're experts at comparing these different methods. But maybe most importantly, they act as your translator. They take all this complicated data and tell you what it actually means for you and your business. So here's the bottom line on that. If the stakes are high, just don't go it alone. If you're talking about a potential sale or you're about to walk into an investor pitch, getting a professional valuation, that's not an expense. That is an investment in making sure you get the best possible outcome. You know, we started this whole thing feeling a little bit lost in that maze, right? Confused by all the different formulas and paths. But now you have a map. You get the different approaches, you know what traps to look out for, and you've got a real strategy. And really, that's the biggest thing I want you to walk away with. The point of all this isn't to find one single magical number. The real goal is to build a confident strategy, a strategy that gives you a clear, defensible, and honest understanding of what your business is worth. So, you've got the toolkit, you've got the map, you know the right questions to be asking yourself about your data, your business, and where you're headed. So, there's really only one question left to ask. Which path are you going to explore first?